every bear market in Bitcoin history has had some overexposed prior buyers that have to sell. Like last time we had Luna buying, Terra Luna was buying Bitcoin when things were good, and then when its whole thing was imploding, they had to forcibly sell their Bitcoin into the market. That was one example. You could certainly have that kind of thing happen again with some of these Bitcoin treasury companies, or more broadly, these other altcoin treasury companies. And that's where I actually would be concerned around more of the bubbles is in the altcoin space. But even in the Bitcoin space, it can get overdone. But Bitcoin is a proof of work network. Right now, the leverage in the treasury space is pretty manageable.
In recent discussions on Bitcoin's market dynamics, experts have been weighing the potential risks of asset bubbles and technological threats to the network. Notably, Lyn Alden, a leading macro and crypto analyst, has provided detailed insights into these issues, addressing both investor concerns and the broader implications for the cryptocurrency ecosystem. According to Alden, while Bitcoin and related treasury companies can experience periods of overvaluation, the underlying network itself remains resilient, with overleveraging being the primary short-term concern rather than systemic collapse. Instances such as MicroStrategy trading at more than 3 times net asset value or MetaPlanet in Japan reaching 6 times illustrate moments of market euphoria, yet these tend to self-correct as market discipline returns. Alden emphasizes that Bitcoin's structure, particularly companies holding significant reserves, is designed to withstand typical market fluctuations. Pure-play Bitcoin companies, those whose primary holdings are Bitcoin, tend to be first movers and are generally better positioned for long-term stability. While past events, such as forced liquidations by Terra Luna, demonstrate that even large players can contribute to short-term volatility, these events have not compromised the integrity of the network itself. According to Alden, monitoring leverage ratios and net asset values is essential, but the broader trend indicates a robust market infrastructure capable of managing episodic shocks without undermining Bitcoin's role as a decentralized monetary asset. One of the longer-term concerns frequently raised is the potential impact of quantum computing on Bitcoin's cryptographic security. Alden, consulting directly with technical experts in the field, notes that quantum computing does not pose an immediate threat to the network. Certain legacy signature types could become more vulnerable over time, but Bitcoin's software architecture is upgradable. With planned updates and potential hard forks, the network can introduce quantum-resistant protocols without endangering its core functionality. This approach, Alden explains, mirrors technological evolution in other industries, such as network communications, where updates improve resilience while maintaining backward compatibility. Before we dive into Lyn's sharp insights from her latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
And the NNAVs have already come down pretty significantly from their bubble heights. So, while I do think that if we have this conversation years from now, I think we'll be looking back at the bear market and say, look, this company XYZ had to liquidate its coins right in the bear market, and maybe multiple of them. So there will have been some capitulation. But I think the overall trend is fine, is how I view it. It's one of the bigger hurdles that might have to be overcome. I tried as best I can to defer to the technical experts in this area. So I directly talk to those who either are involved in quantum computing, those who have proposed updates to Bitcoin to further make it resilient against quantum computing, and things like that. Those that are trying to build companies that are addressing potentially some of the quantum vulnerabilities. The short answer is that Bitcoin is upgradable. It already gradually updates over time. Most of those are not consensus changes. Some of them are consensus changes, more rarely. And so with Bitcoin, the main vulnerability is not the core encryption itself. It's not as though the first time you have a quantum computer, it can just unravel the whole Bitcoin blockchain. Instead, certain signature types become increasingly vulnerable should there be a sufficiently powerful quantum computer. And so one of the first steps that people can do is, if they're in those generally very old address types, they can move them and take other practices to defend their own coins against potential security issues related to quantum computing, should it materialize faster than people think. And then two, the Bitcoin network itself does have some potential soft fork updates that can add new signature types that are more quantum resilient than even the better ones are today. Generally speaking, the downside is that they come with more block space. So in Bitcoin, there's kind of a limited amount of block space per block because it takes up bandwidth, it takes up storage. And so you generally don't want to use a bigger signature type than you have to. But should that day come, or should developers and investors get worried that it's coming soon, there are upgrade paths to protect it. So my general view is that it's not a non-issue. I have put considerable time into talking to the people that directly work on it in their programming or in their other capacities. And I'm satisfied that the Bitcoin network has methods to circumvent it. I also don't think it'll hit in an investable time horizon of, call it, 5 years. But I do think that I am glad that there are people that are already sketching out which signature types make sense, what types of upgrade paths would be doable, and things like that. So I don't view it as a likely existential threat, but I do think it's one of the ongoing serious risks that people do have to consider. If you have a hard fork happen, the chain would split into two. Ostensibly, one of them would be more quantum resilient than the other. And any current holder of Bitcoin would now have that number, but they'd have both coins. Now, historically, when Bitcoin has done hard forks, I mean, anyone can do a hard fork. I could do a hard fork this evening, just no one would buy it. So anyone can do hard forks. It's open source. But in Bitcoin's history, there have been a handful of serious hard forks, meaning that there's an amount of scale behind it. There are a number of large buyers, large miners, things like that support it. Historically, the hard forked coin, the one that's no longer backward compatible with the existing node network, that has historically not done well. That generally will fall in price and that value will get reabsorbed into the main chain. Now, should there be a scenario where quantum risks materialize and there's a quantum resilient hard fork, that's a possible scenario where the newer fork is the winner and becomes the new main Bitcoin. The way that users can protect themselves is if you just hold both coins, you get the benefit of whichever one wins. It reabsorbs the value of the other one. So, for example, when Bitcoin and Bitcoin Cash split, if you did nothing, you still hold all the Bitcoin you had pre-split, and you'll have an equal number of Bitcoin Cash, which is worth de minimis now compared to the Bitcoin, but you haven't lost any of the Bitcoin that you had. On the other hand, there were some, say, experts at the time that had very high conviction that Bitcoin Cash was not going to win, and so they could actually sell their newly generated Bitcoin Cash and even increase their stack of Bitcoin. So someone's high conviction, they could be right or wrong, but they can sell the fork that they don't think is going to win, double down on the one that they think is going to win, so it's an opportunity. But if someone's not sure, which is probably the vast majority of people, they just can hold both just by doing nothing. And they get the benefit of whichever chain wins. I would say yes, because it's not as though there's one entity that can just do a fork. The fork is decided by the market. And so, for example, when Bitcoin and Bitcoin Cash split, the market decides what is the true Bitcoin. And so by simply holding both, it is true that now there's 42 million coins because you have 21 million Bitcoin, 21 million of this fork, but that fork devalues. So Bitcoin Cash is worth like 1%, for example, roundabouts of the Bitcoin network. And so it didn't really take any share other than the first several months of that contest. So there's this kind of brief period of time where there's this narrative clash. But then when the dust settles, actually, I would say it was actually a strong case for Bitcoin being hard money because you had major exchanges, major miners all trying to forcibly change the Bitcoin network. And all they did was basically create their own copy of it that then slowly disintegrated back into the main Bitcoin chain, at least all of its functional value. And so Bitcoin as a software network can update over time, but kind of like how USB became USB 2 and became USB 3, and kind of like how Ethernet has the Cat 6, Cat 7, Cat 8 cables that underpin network connectivity, they all update and get faster over time, but they're still backward compatible. They're still kind of their core system. That's generally how Bitcoin updates. And so it's this period of time where it does change, but it's not as though there's one central issuer of that change. It's a distributed network.
In the event a hard fork is required to implement these upgrades, the blockchain would temporarily split, creating both legacy Bitcoin and quantum-resistant Bitcoin. Alden clarifies that this process is market-driven. Users holding Bitcoin retain access to both chains, and historical precedent shows that weaker forks typically reabsorb into the main network over time. This consensus-driven approach reinforces Bitcoin's credibility as a form of hard money, as no single entity can unilaterally dictate changes. According to Alden, these governance mechanisms ensure that Bitcoin's scarcity and value proposition remain intact even under significant technological stress. When comparing Bitcoin to traditional gold, Alden continues to frame Bitcoin's evolution as the emergence of digital gold, a modern counterpart to centuries-old stores of value. While both assets share scarcity as a defining characteristic, Bitcoin offers advantages that gold inherently cannot match. For example, Bitcoin's digital nature allows holders to store and transfer value across borders with ease, bypassing many of the logistical and regulatory challenges associated with moving physical gold. Additionally, Bitcoin can be securely held in distributed, multi-signature wallets, enabling geographically diverse self-custody that traditional gold cannot achieve without incurring significant storage and transportation costs. Alden underscores that these features, while introducing a degree of technical complexity, provide a level of flexibility and accessibility unmatched by physical assets.
Of liquidity, there's also a network effect of security. So, for example, the main chain, miners on that network could potentially 51% attack the weaker network, but the reverse is not true. So generally speaking, once a chain becomes the dominant one, it's very self-sustaining. And only during kind of very brief windows in time is it ever seriously challenged. Like, for example, back in the block size war, there's that kind of disagreement around store of value versus payments and who gets to decide when it changes. And the status quo won. Should quantum become a serious threat, and people disagree on how fast or in what way Bitcoin should update to it, there could be multiple different approaches, and then kind of the market chooses which one wins, which one kind of becomes or remains the leading network of liquidity and security for digital money. If for those that are not sure, you just hold the fork, you hold all coins, and then even as the dust settles, the weaker ones get reabsorbed back into whatever the main one is. It could be the one that already was, or it could be a fork that you still have coins of if you just did nothing. I would say that it's a scarce network, right? So it's not going to accept a change that makes it worse, right? So for example, you can run your own node. You get to determine what version of the network you run. And so if someone comes along and says, here's an update, it basically increases the number of coins and gives those coins to person XYZ. I would say, well, I'm not going to run that update because that just makes Bitcoin worse. And that's why anyone can propose unpopular updates and they don't get absorbed into the Bitcoin network. Only extremely popular changes, things that fix a minor bug or things that potentially increase its resilience against attacks, quantum or otherwise, could have and historically have and potentially could get absorbed into the network as useful updates. Generally, those things are only things that make it stronger. I think it's best looking at Bitcoin as a network effect communication protocol. So kind of like how Ethernet is very hard to disrupt, USB is very hard to disrupt, simple mail transfer protocol is very hard to disrupt, internet protocol is very hard to disrupt. Then you can look at social networks. I mean, people can make a million Facebook clones or a million Twitter clones, and it's very hard to displace the dominant ones at what they do. I think Bitcoin's in a similar capacity. It's a communication protocol of value. It's been the biggest for 16 years straight since it was developed. By far the biggest liquidity, by far the biggest security, basically the leading network effect in most metrics that matter. And I think that 5, 10, 15 years from now, that'll still be the case, and we'll reassess from there. And basically, it's this scarce. Basically, instead of relying on a nature to run your ledger, which is gold, and it's a useful way to do it. The other way is these big centralized ledgers, which is fiat currencies, and we've already spent this program discussing kind of the downsides of fiat currencies, all the debasement and defaults that can happen. And this other third option is a decentralized ledger.
Mm-hmm.
And then you say, well, if this thing is valuable, and many people have said it's valuable because you can hold an asset that no single entity can just snap its fingers and shut down. Then you say, okay, well, what's the biggest one? And does it have sufficient network effects and self-sustaining security to persist. And I would say Bitcoin has reached that state. And so when you compare, say, Bitcoin and gold, they've got pros and cons. I mean, gold is this, 1,000-year-old monetary asset, um, and it has the downsides are that it grows something like 1.5% per year indefinitely. So you get that kind of long-term debasement at a pretty gradual rate. In addition, it has portability issues. So if you're, living in Lebanon and you want to take all your gold and go to another country, good luck. I mean, there's certain, especially in fiscal dominance or capital controls or things like that, there can be all sorts of frictions against moving self-custodial money. Like I said, I live part of the year in the U.S., part of the year in Egypt. It's not like I'm not going to bring all my self-custody gold with me at any given
Hmm.
time. If I'm going to have access to my own money, something like Bitcoin's more useful to have this kind of geographically segregated multi-signature setup, for example. And Bitcoin has that portability
Right.
that gold doesn't have, but it does come at the cost of there is this technical complexity. It's a 16-year-old network. It's 1/10 of the size. It's less understood than gold. And so there are these trade-offs between these two types of monetary assets. But there is an objective answer for that, that's basically governed by nature and physics, and the history of how many coins got there and were made and moved around. And the way it's updated is by physical possession, by exchanging the coin itself, or to some extent, by changing legal proxies of who owns that coin. But ultimately, it's about who actually has possession of the coin. So that's basically letting nature run a ledger of these tokens that we made out of nature's parts. The other main option in history is to use humans as a ledger, to basically say, well, this bank is the ledger. So if we both hold money at that bank, and I want to pay you, I can just tell the bank, deduct from my account, add to your account. Or the bank can issue banknotes, and I can hand you banknotes to just basically move around our units of the ledger. In a really big system like we have today, we have all these banks tie into central banks. So it comes down to one big national bank running the ledger that we use. So how many units of the dollar are there? Well, that's determined at the base level by the Fed, and at the broad level by a combination of the Fed, the government, and commercial banks. They collectively determine how many broad units are there in the system, tied into the base layer, which is basically the Fed. So we're relying on basically one group of individuals that are determining what is the kind of their lending rate for that money and how many of those units are there. And so we have to rely on them to keep it stable. And they've already they choose to have a long-term debasement. They basically want to have positive inflation, so they want to have prices increase despite the fact that human productivity goes up over time. So they want to gradually increase those units, and that they're operating the ledger so they have the capacity to do that. And then the third option is to say, well, instead of letting nature run it, and instead of letting just one entity or one council run it, there's a way now to run ledgers in a more distributed way. And it's more like a super large federation, you can think of
Hmm.
it, or in a more distributed sense, it's potentially tens of thousands of entities participating in a ledger, and it comes with governing logic that is purposely very hard to update. So it's not that it can't update, but that updates can only be chosen by the network. No one can send out an update to all nodes. Nodes have to choose to say, I'm going to accept this update, and it's open source so people can audit it. And then they have this kind of ledger that they're operating together. And then
Yeah.
if it's a proof of work network like Bitcoin, there's also an energy component into basically how that ledger is maintained. But basically, it's just this third option for running a ledger. So at the end of the day, money is kind of this divisible thing, this divisible liquid thing that we're moving around. And then just the main question becomes, who controls how many units there are, and what's the recording authority that determines who owns it?
Looking ahead, Alden provides measured forecasts for both Bitcoin and gold. Over the next year, she projects Bitcoin could reach $150,000, while gold may approach $3,800 to $4,000. In a 5-year horizon, Bitcoin could exceed $250,000, with potential corrections along the way, and gold may reach $4,000 to $5,000 or higher. These estimates, Alden cautions, are contingent on evolving market conditions, technological developments, and global economic factors. Ultimately, her analysis underscores that while Bitcoin is susceptible to temporary bubbles and requires ongoing vigilance against emerging technological threats, the network's underlying design and governance mechanisms position it as a resilient and increasingly mainstream store of value. Drop your thoughts on experts' analysis in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.